Good afternoon, you're watching Bloomberg Quint Live. I'm Alex Matthew and here are the headlines. Indian markets trade flat with the Nifty holding on above that 10,300 mark. Petronet LNG gains as much as 6%, the most in almost a month after its second quarter profit beats estimates. Tata Motors, HPCL and Aurobindo Pharma are the three Nifty companies coming out with their earnings today. US President Donald Trump says China is taking unfair advantage of American workers and companies, but blames his predecessors for the situation. Now don't go anywhere. Up next is Hot Money with Darshan Mehta. Darshan?
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Joining us on the show today is Sangeet Lakkar of Newberry Capital, Avinash Gorakhshekar of Joindre Capital, and T.S. Harihar of HRBV Client Solution. He joins us on the show, but due to traffic, he's a little late, so he'll join us in a while. But we'll start with the other two guests. Today on Hot Money, we'll discuss stocks like Balkrishna Industries, CESC, United Breweries, Arvind, and Castrol. Let's start with the first one, and that is Balkrishna Industries. The numbers came out yesterday, not the best of numbers. We've seen the tire stocks, at least for this quarter, have not reported the best of numbers. But a bonus of 1:1 is that's something keeping the stock abuzz. The stock is trading at pretty much record highs. What should one do? Should someone stick with Balkrishna or shift to some other tire stock? Let's ask our guest. Avinash, do you share a view on Balkrishna Industries?
Yeah, Darshan, I think this is one of those tire stocks which actually has a very niche market in the off-road segment. In fact, there are large players, for the mining, agri, construction segments. And in fact, if you look at the business model, this business throws a EBITDA margin of almost 30-31%, which is very attractive. And most importantly, they have a reasonable debt on the balance sheet, extremely cash rich. And most importantly, numbers like return on capital, return on equity look to be very strong. In fact, in terms of capacity, they have a 3 lakh ton capacity. So they are very well equipped, at least for the next couple of years. So no major expansion should be lined up. So clearly, in terms of the operational benefits as well as the operating leverage coming in, I would believe that yesterday, they gave a 1:1 bonus, and they're pretty confident of a volume growth of around 1.8 to 1 lakh tons, this year. So probably, on dips, this stock definitely can be worth considering the fact that the margin expansion is definitely very much possible. And I would believe that yes, the order book is still very strong. So probably buy on declines. Yes, it's gone up significantly, but looking at the kind of trajectory in earnings over the next, say, 12-18 months, I would definitely buy it on decline.
What's your best pick in the tire space, Avinash?
I would believe that, within the tire space, I think most of the tire stocks look to be fully priced. I think something like a JK Tires possibly could be a better choice, considering the valuation discount it enjoys. But considering an opportunity, if one were to buy this stock, I would believe that if one were to look at FY20 earnings, here you're getting visibility, a very solid kind of business, very little competition from the domestic play. And most importantly, if the rupee weakens, I think some amount of currency benefits also flow in. And obviously, the business itself is going to throw up very strong free cash flows over the next couple of years.
And you're happy with the valuation 18-20 times? It's slightly expensive than a CEAT or an MRF, but it's a niche play.
No, but in this kind of business, when you get a EBITDA margin of 30-odd%, you have very small equity of just 19 crores. Now it doubles after 1:1 bonus. But still, if you look at the operating metrics, I would still be comfortable to put my money in this kind of market, because it gives me comfort that unlike a CEAT or maybe a Apollo Tires, which have got typically a very kind of homogeneous kind of product, this is not a me too product and a very not an easy competitor product where you can easily take away market share from Balkrishna.
Okay. Sangeet, I'll come to you. Just look at the chart on your screen. They were just showing the performance of a Balkrishna Industries compared to its peers, and it's been a marked outperformer, be it on a year-to-date basis. So when CEAT and MRF have been negative returns on a 6-month basis, Balkrishna is up 17%. Does this deserve this kind of premium? What's your view on Balkrishna Industries?
So I'm very positive on the company. I think at the outset, sheer comparison of Balkrishna with MRF or CEAT, or for that matter any other tire stock, is incorrect. You have compared the price chart. Now if you compare the earnings chart, not only for last 1 year but last 10 years, say, you will come to know why is this company so different. Now, first of all, there is absolutely zero threat from China. The company has about 2,400 SKUs. So it's a very, very labor intensive business. unlike the other passenger vehicle tire manufacturers where it is more of mass production. That's where the Chinese threat come from. They compete only with select few US based companies or Europe based companies. Now, if you see the market as such, it earlier used to be a 15 billion market. The market size itself has contracted to 10 billion market. But interestingly, Balkrishna sales has doubled for last 5 years.
Okay.
So it has been capturing incremental market share from the other players. Why is it capturing so? Because of the cost advantages it has. As I mentioned, it's a labor intensive business and there is a huge labor arbitrage which they enjoy in India. I remain very positive on the company as such, whether you take it on financial parameters or on business parameters. Consistent 10 years EBITDA margin of about 30%. You hardly find, so it's not a commodity business as such, you know. So I remain very positive on the company.
Okay, so that's the consensus view that we're getting in on Balkrishna Industry. It's a double thumbs up in terms of the stock, even though the results was not the best, but yeah. The past performance does prove that, you know, there is significant amount of traction. Let's move on to the next stock, CSC. Numbers came out yesterday. It was a weak operational performance, but, you know, all eyes on, you know, when the entire demerger will happen. Will the company actually create shareholder value? What's the view ahead? Sangeet, do you have a view on CESC?
So I have a very limited understanding of the business. What I understand is about 80% of the business comes from power generation and power distribution. Yes. Power distribution is something which is a highly regulated business. I don't think you will have an instance where government will allow you to make abnormal profits in this kind of business. The retail business, yes, that's a good. That's a good business, but it's a very small part of the pie. So once the demerger goes through, then we probably take a call on the specific businesses that we have.
Okay. What about you, Avinash? Any view on CESC?
No, I think as Sangeet mentioned, you know, I think the distribution business is the cash cow business, and obviously returns being regulated, you may not see a very sharp upsurge in earnings, but it gives a fair amount of comfort. In fact, they are the largest distribution companies in Kolkata and Howrah, and have a very large customer base of almost 2.9 million customers. I think what is important is after the demerger, what happens to the retail business and the distribution business, because in terms of distribution business, it will be a unique play, you know, the one of its kind to get listed. The Spencer business has also now broken even. We hear that the debt on the balance sheet has also come off. I think probably that would be the trigger point for the stock, you know, once the demerger takes place post December 2017. That is when the demerger actually will happen, and most importantly, the power gen business and the IT part of the business could remain underperformers, but investors could definitely take a call on the retail and the distribution business, which I feel could possibly get a kind of good re-rating in the market.
But the news of the demerger is out, so once you think there is still is it fully priced? Are you happy?
I would say it is more or less.
The valuations are not expensive. One-time price to book, P of 13 times. So
ahead of the merger, I think there could be some stock action, but otherwise, if looking at yesterday's numbers, Darshan, I am not very much impressed by the kind of numbers. So I think probably I'll wait for the demerger to happen and then pick out something like a Spencer or maybe a pure distribution play. But at the current level, I don't think you're going to see a very big kind of incremental upside coming in.
Okay, that's the view on CSC. Welcome, Hari. I think the traffic is something that no one can predict, but I'll get your view on CSC. We already discussed Balkrishna. Let's talk about CSC. Any view on CSC? What's your view?
So we like the stock, and I agree that the Q2 was a little disappointing, at least compared to what we were expecting from CSC. But I think the big story of CSC was never about the results. I think the big story is about the demerger of the Spencer retail business, because I think it's the Spencer business that's going to actually add what I call the alpha as far as the CSC stock is concerned. I would broadly agree that there may not be too much of earnings-driven upsides on this stock, but I think the demerger could be a good sentimental positive. So yes, I think probably 1200, 1250 looks to be a distinct possibility on CSC.
Okay, we missed your comment on Balkrishna. Both of them were extremely positive on Balkrishna. Would you want to give your comment? What's your view on Balkrishna Industries?
Oh yes, in fact, we like the entire tire space as far as the sector is concerned. In terms of valuation, I think Balkrishna is fairly valued. It's about 20-21 times past earnings and about 18 times forward earnings. So I think even in earnings term, PE terms, I would believe that Balkrishna is fairly valued. I think it leaves about 20-25% upside room as far as the stock is concerned.
Okay, but why are you so bullish? What's your rationale of valuation is fine, but the results are not the most impressive.
I agree. We are actually looking at it as a very smart auto ancillary play. Because I think we expect auto demand to grow pretty fast, and the tire prices, the tire input cost to remain under control over the next 2-3 quarters. So that's what actually is driving us. And as I said, the overall tire industry looks good. Within that, Balkrishna looks to be one of our big picks.
Okay, so that's the view that's coming in from Hari for both Balkrishna Industries as well as CESC. Let's move on to the next stock, and that is United Breweries. Numbers were good, if you look at the numbers, they were good this time. But are valuations sustainable? Look at the valuation on an FY19 times, it's trading at almost 76 times. The price to book is almost 10 times. So numbers were decent. It had run up significantly ahead of the numbers. Today is down 5%. Should one buy this stock at such valuation, or is there growth that could come in? We'll ask our guest. Avinash, start with you. Are you bullish on United Breweries, and according to you, are valuations fair?
I think I'm positive on United Breweries. Numbers which were declared yesterday were very strong, volume growth of 11%, and this comes on the back of the GST problem, the problem of banning liquor shops on the highway, which got reflected in the Q1. But I think despite that, if you look at the overall EBITDA growth, a 72% growth in EBITDA is definitely commendable. Most importantly, the Heineken stable of products is slowly getting introduced. There's been a good market share kind of increase for the company. I would believe that yes, there was almost a 25-30% kind of bump up on the stock price ahead of the results. So a lot of action happened before the results. So probably the stock may consolidate or see a little bit of profit booking. But I'm quite confident that despite all the negative headwinds on liquor ban, most states removing liquor, I would say that this is definitely a stock to watch out, and maybe on a decline, this can definitely be considered as a kind of a portfolio pick for next say 2-3 years, because this is a strong consumption space where I believe margin improvement could come in, and the management is pretty hopeful that margins could actually improve from here on. So yes, valuations are expensive, it's not cheap, but I would definitely look at it as a 2 to 3 year kind of call, and obviously buy it on any decline.
Okay, Sangeet, I'll ask you, are you happy with such valuations, or would you be cautious on United?
So I am neutral to the counter. On the near term basis, I am a little skeptical. So there was a news article which I think a lot of people missed, that there was a delegation from Karnataka that was sent to Bihar to study the impact of the alcohol ban. And Karnataka is due for elections next year. And so, I mean, that's a huge risk to me, So on the near term, I'm a little apprehensive. But yes, if you talk about the sector, I like beer as a sector. So if you see the Indian alcohol market, beer commands about 11% of the total alcohol market in India. And India being a tropical climate country, plus a young populated country, so beer growth, I think, would be more as compared to the spirits. Within the beer, this company commands about 51% market share. So it's by far the market leader. I think the first two command 70% market share. So
this is the second one?
I'm not too sure about the name, but the first two players commands the 70% market share. So, I mean, on a longer term basis, the growth is definitely going to come in. I'm not too concerned about the valuations also. I'm just concerned about the government interference.
But you are okay, 76 times is fair for a
looking at the opportunity which we have, I think I'm pretty okay.
Is United Breweries the only listed beer stock in the
No, there are many. You have GM Breweries, but that is more regional play in Maharashtra. You have, I think there are allied distilleries and all that, but I'm not tracking those smaller companies.
Okay. Hari, any view on United Breweries?
Well, I'm negative on most of the sin stocks, and largely because I believe that at some point of time, all these sin stocks are going to get into some serious regulatory issues. And see, I agree with the point that Sangeet made, that we have seen in Bihar, we are now seeing in Karnataka. Probably it could become a reality in Karnataka. And my hunch is there are a lot more states where you could see these liquor bans coming in some form or the other. And we have seen in the last 2 quarters that liquor ban, highway ban, that has impacted. And it is going to become like what cigarettes are becoming in India. You see, ITC is still earning a chunk of its revenues from cigarettes, but then the way cigarettes are being taxed, the way cigarettes are being banned in various places, I think the industry itself is going through a major change. So I believe that the liquor industry will also go through a similar change. And at 75 times earnings, I honestly feel it's not worth it. If you really want to buy a liquor stock, if you're so keen on buying a liquor stock, I think a GM or a KDA, I think they look to be better priced, and although I should say the regional place, they look to be better priced compared to United Spirits. But United Spirits for me at least is a strict no.
Okay, GM Breweries is a better choice.
GM, yeah, as you said, it's a regional play, but I think in terms of valuation, it's definitely a better play.
And GM came out with a very fabulous set of numbers.
Yes, yes.
But that came on the back of 3-4 quarters of disappointing numbers because of the alcohol band.
Yeah, but I think even in valuation terms, to look at it, it's not as expensive as United Breweries is.
Okay, so that's the view that's coming in on United Breweries. Avinash is very bullish on it. Sangeet is saying yes, for the long term, yes, it's a good hold, but not at least, but regulatory issues are there. Hari is not bullish on the entire liquor space or the entire, if you call the sin stocks, the cigarette stocks, the liquor stocks. GM Breweries could be probably a better pick. But before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, the next stock that we'll speak about is Arvind. The big news that came out yesterday was the big demerger that they're planning to do as far as their retail business is concerned, their engineering business is concerned. The counter had run up significantly ahead of the numbers. The results were not great for Arvind. It had moved up on the anticipation of the demerger, and once the demerger was announced, probably it was sell on news. The counter ended down 10%. Today, it's trading up 2%. Now the entire news is out, all the analysis is done. Should someone bet on Arvind because of this demerger, because of any other story? I'll ask you, Hari. All the news is out. Whatever was gained there was this big 10% drop. Now the company is back at square one. Now all the details are known of the demerger. Is it a good demerger? Should someone bet on Arvind, or is it a better opportunity somewhere else?
See, if I was to look at the textile space per se, I think that this whole concept of demerging your brands from your core textile business is a very good business. And let's understand, the shareholders of Arvind are going to get shares of Arvind Fashions in 1:5, shares of Anup Engineering 1:27. So there is something that the shareholders are going to get. There is going to be, I think, a 7 to 8 months time before all these shares get listed. So there is going to be a certain, what I call a time lag before you will get all these shares. But then that's a different issue. I think what's important is that typically the textiles business gets a fairly low discounting vis-a-vis the EV by EBITDA. It's about 6 or 7. I think brands is about 21, 22. So once this breakup happens, you will have a Arvind Brands or Arvind Fashions that is quoting at a fairly rich valuation, and Arvind Mills that is quoting at a existing valuation. So I think that should probably serve the combined entity much better. And so we like that. Yeah, there are concerns about results, there are concerns about valuation, but I think if you look at the India textile story and the India consumption story, I think Arvind is a great bet, and this is a good move from the valuation point of view.
Okay, what about you, Avinash? Was this a good demerger? Is it already played out in the price, or is there more?
No, I think, Darshan, I think the valuation ratio, that is 1:5. I think markets were expecting a more liberal kind of a ratio for at least the branded business. But yes, I think the bigger upside could come in from the branded retail business, because here 10% has already been taken by a large PE investor multiples. So I think here the markets are looking at a significant premium on listing when the business goes independent. And they gave a perspective on kind of EBITDA growth. I think currently it's about 150-60 odd crores, which they intend to at least double in the next 2 years, and hopefully this will be a $1 billion business by FY20. Currently the top line from this business is about 2,900 crores. So I think growth is definitely going to come in. The business is very attractive, and branded business, as Hari said, will definitely get a good valuation multiple. So to that extent, the stock definitely can be accumulated. But yes, the engineering business or maybe the traditional textile business, my sense is once it gets listed separately, I don't think you're going to see any big fancy in those stocks, because the business traditionally has been enjoying a low return on capital employed. So all said and done, maybe the stock has run up, I mean, as you rightly pointed out, but maybe a further decline or maybe a slight correction on the price would give a good opportunity to play on the retail story, or maybe independently buy the stock when the retail business gets listed, say after 8 to 9 odd months.
But are you happy with the ratios and all? Does it make so if let's say an investor is watching or a retail shareholder is watching, according to you, does this make sense for an investor, this ratio? Is it fair for him? Is it unfair?
I think clearly, if the ratio was slightly skewed better, instead of 1:5, if it was slightly better, because that was probably the reason, despite the news, what you said is right, sell on news. But clearly the ratio, I mean, according to me, I think could have been slightly better in favor of the retail guys. Probably, the engineering business is not something great. So probably, probably there one could have a slightly skewed distribution ratio and a more liberal ratio for the branded business, which I think eventually, I think, we'll see how the institutional investors actually react to this.
What about you, Sangeet? Arvind, what's your view?
So I don't have a real view on the stock. In principle, this is largely the alpha is going to come from the retail business. But So we have seen a lot of promise for last 3 years that the urbanization, premiumization, the branded retail space is going to go at a scorching rate with per capita income increasing. But actually, if you see on the ground what is happening, if you see the growth is nowhere coming to what was being showcased. Whereas if you see some other regional players, so something like a V2 retail or a V-Mart, we are very, very tier 2 focused, operating in Uttar Pradesh, operating in Bihar. If you see that growth numbers, they are showing visible growth. So I might as well, it looks like more to shift towards a value play rather than to play the premiumization trend. Okay. But I don't have a real view on Arvind as such.
Anything else that you like in this textile space?
As I told you, V2 and V-Mart.
V-Mart, those are your picks for the sector. Okay, so that's the view that's coming in on Arvind at this point of time. Hari as well as Avinash are indicating that it's a good trend, it's a good stock. Sangeet does not have a clear view on Arvind, but he would say that a V-Mart or a V2 retail would be probably a better pick given the fact that they are very focused on tier 2 cities, and that is where the real growth is coming out. And let's move on to the final stock, and that is Castrol. Again, the same news. The numbers were strong, the volume growth was strong, and again it had run up significantly ahead of the numbers, and now post the numbers it saw a lot of selling that came out. Today it's trading flat in trade. Strong quarter numbers. What's next? Should someone stick to a Castrol? How will the higher moving crude prices affect Castrol? Is it better to switch to a Gulf oil lubricant or a Tide oil water? We'll ask our guest. Sangeet, your view on Castrol, are you bullish or bearish?
I am bearish on Castrol because I am bullish on its immediate peer, which is Gulf oil.
Okay.
So if you just compare the numbers, so first of all, both the companies are trading at similar valuations. It's not cheap, it's trading at 30 times. Both the companies are trading at similar valuation. However, if you see the Gulf oil growth, so they reported a growth, profit growth of about 38%, vis-a-vis Castrol's growth of about 25%. And that growth trend is visible across last couple of years from where they are operating. Another instance is you have so if you compare both the companies, Castrol promoters have been selling. You had instances of 2 times where the promoters sold, whereas Gulf oil promoters are buying. So that gives a lot of comfort, and if I'm getting both the companies at same valuation, I might as well choose growth on a lower base than a more matured company.
But what kind of margins, if you've done the comparison, what kind of margins does Castrol command versus, I'm talking about on the pure financial play, how do both of them work out?
So obviously Castrol is more premium, so it has a higher margin. But having said that, I would look at the profitability growth, to value a company. So it doesn't matter even if they are commanding a slightly higher margin. But if I can see growth, and if both the companies are available at similar valuation, then I might as well choose the latter.
Hari, what's your view on Castrol? Is it fair valuation? Almost 27 times next year earnings.
See, let's understand one thing. I think Castrol is not just a lubricant space, it's also a very strong brand play. Because globally, Castrol is a very powerful brand. So somewhere I think the valuation has to be looked at partially oil, partially FMCG. So I think that is the kind of valuation you need to look at for Castrol. I think from that perspective, I think 25, 26 times looks to be fair as far as, I wouldn't say it's cheap, but it's, I think, reasonably valued with scope for upside. I think there's a meeting today and there's a 1:1 bonus that it's going to get X bonus, I think, from a couple of days. So that should probably bring the stock price down and bring it into what I call a more acceptable kind of a price range. So that should, I think, bring a lot more retail interest into the stock. I think on 2 bases, on the margins front and the brands front, we like Castrol as a stock, and we like it within the entire lubricant space. And I think if you're looking at a growth in lubricants, this is probably one stock we would be betting on. So we like Castrol. Again, as I said, it is not a screaming buy, at these valuations, but definitely, yes, if you're looking at the space, we would be looking at Castrol.
Okay. Sangeet also said that, Gulf oil lubricants would be a better play. Do you have any view on Gulf oil?
I am not tracking Gulf oil, so I really wouldn't know, be able to comment on that. But yes, yeah.
Avinash, any view on Castrol?
No, I think I'm also neutral on the stock. As Sangeet said, valuations are definitely not cheap, and most importantly, with the crude prices going up, the input prices are definitely not going to remain the way they are. And I would believe, the management also gave us a commentary saying that the next 2 quarters are going to be pretty challenging. So I think let's wait and watch. The bonus has also come in. I think I would not believe that there are some near-term very big earning kind of triggers which can re-rate the stock. So I think at best, somebody who's holding on can hold on. It's been a good wealth creator for a guy who's invested a couple of years back. But as of now, there's no incentive to invest. I think, as he said, Gulf Oil has definitely come out with a better set of numbers. So I think that also stock probably on declines could be a better opportunity if one were to play, the lubricant space.
Sangeet, how would rising crude prices affect either Gulf Oil or Castrol?
So yes, in near term it could impact, but ultimately you have to see whether these companies can pass it on to the consumers. So like for instance, if you say Balkrishna Tires, the first stock that we discussed, if you see even the 10-year chart when the crude prices were above $100, when the other tire companies were making losses, this company was consistently making about 30% EBITDA. So that essentially means that they command that pricing power.
Okay.
So I would not be too much concerned. Yes, in near term it could be a sentiment negative, but if they are able to pass it on to their customers, then I don't see a problem.
Okay, so that's the view that's coming in on Castrol. We had actually divergent views on Castrol. Hari is bullish on Castrol because he believes that apart from a lubricant play, it's also a brand play. Sangeet is bearish on Castrol because he's much more bullish on Gulf Oil lubricant because on a like-to-like comparison, he finds it much more reasonable. And Avinash is rather neutral on Castrol at this point of time. Before we wrap up on the show, here's a quick recap of all the guest view on the stocks that we've covered till now. Hari, Avinash, Sangeet, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Thanks for watching Bloomberg Quint.